All right, let's try this again. Let's talk about the banking crisis that Jamie Dimon, FDIC, and Steve Diggle are pointing at. Folks, if you tuned in to the daily financial news that started at 7:30, we had a technical issue on my side where the Wi-Fi decided to go down, so I will be deleting that broadcast. I apologize. But let's get into it. Let's start fresh. Jamie Dimon warns of cracks building in the bond market, and he says that regulators are going to panic. He indicates that the bond market is reacting to the U.S. fiscal mess, which is not something to play nicely with. On top of that, we have the FDIC warning of $413 billion in unrealized losses. That is down $67 billion from the quarter before. However, it is expected to rise as the 10-year and 30-year note rose in the quarter. These losses are significant. Unrealized losses can move to realized. Just ask Silicon Valley Bank, First Republic, and others. This can be a problem if there is a bank run. On top of that, we have participants from the great financial crisis who created $1 billion in profit by going long volatility and short credit. Specifically, Steve Diggle from Treasuries fund, who made is estimated $3 billion 14 years ago. Steve Diggle basically, by shorting credit risk and going long volatility, he was shorting the housing market. He was silent. Oh, looks like I am back. This is very frustrating this morning and a little bit nerve-wracking, I will admit. That's what happens when you do these live. But back to Steve Diggle. He's back in a big way. He sees there's mispricing of risk, just like the GFC. He highlights that there are 4 areas. Today, it's not mortgages, but it is private equity and private credit. He indicates that central banks are not in a position to save the market. They can't come in with mass QE. Number 2, there's inflation in the system that will be exacerbated should the Fed and central banks print money. Highlights that there are geopolitics at issue. Also, obviously, people are repositioning assets around the world. And then, of course, indicates that the U.S. market is roughly 2/3 total market valuation, which he thinks will go the other direction. So what's going on? You have Jamie Dimon, the largest banker in the country, warning of cracks in the bond market, indicates that regulators are going to panic, and the U.S. fiscal mess, the big, beautiful bill, is not getting better. We were promised it would get better. It is not. So we have that. Then we have Steve Diggle, somebody who was very profitable in the GFC, re-entering the market. And we have FDIC telling us there's almost $500 million in unrealized losses. This is not warm and fuzzy. On top of that, we have other things going on in the news. We've got Zillow talking about 27 of 50 states that home values dropped year on year. If you don't know already, the spring selling season was a complete disaster. As expected, we've been telling you all year that transactions will be sub 4 million, and we are well on our way. To that end, where we dropped last time, Newsweek featured Reventure Consulting, Nick Greeley. Several of you sent me this article over the weekend. Nick is basically blaming the housing crash on investor collapse in demand. Basically, investors pull out of the market and is going to cause price drop. He says that investors are down 65% in Atlanta, 63% in Jacksonville, and 61% in Charlotte. Investors lead to bubbles and crashes, according to Reventure Consulting. When they leave in droves, crashes can get worse. We actually have some historical context here. if you go back and look at the charts of Phoenix, Arizona, you can see, I think it was in 2022, there was a big run up. Those were the iBuyers. And then, as you may recall, late 22, early 23, the iBuyers left in mass. And you could look at the chart, right? It ran up, came down. Once the iBuyers were gone, it started to run back higher. So it's interesting to hear that investors are going to be blamed for the crash, according to Nick Greeley from Reventure Consulting. On top of that, there is some language in the big, beautiful bill that passed the House, is now in the Senate, that should be concerning to all of us. It appears that there's a U.S. foreign tax bill, Section 899, if you want to Google it, that will increase taxes for investors from certain countries. It will increase taxes 5% a year up to a maximum of 20%. Is this a good thing? Is this a bad thing? Well, it depends on what you look at. Number one, you could look at this as new tax revenue. You could say, hey, great, we're going to collect more taxes. It's going to pay down the debt. But in reality, folks, this is no different than taxing the rich, doing something like that. You are going to create opportunities for marginal dollars to flee the United States. Think about it. Think about this. Just for example, you're an investor in Japan. You've been borrowing the yen and buying U.S. assets, the yen carry trade. Well, you've seen the yen 30-year bond explode higher. I think it was over 3% last time I saw. I could be wrong, but it was up significantly. It's now close to what the U.S. 10-year Treasury is. So maybe you decide to sell your U.S. Treasuries and repatriate your dollars back to yen in Japan and avoid these extra taxes. If you're going to start taxing investment dollars, they're going to evaluate where they're best served. Money, cash, investments go where they are treated the best. And given a lot of changes in the big, beautiful bill and elsewhere, they're not being treated well in the United States. And we are going to see increasingly the marginal dollars flee the United States. This will be a problem. If you take 10% of foreign investments and you put them elsewhere, who's going to step in? Who is going to step in? Folks, this could be a problem. More capital will leave the U.S., is my opinion. We did have a bunch of people join school this 48 hours. Jeffrey, Dejvi, Joseph, Thea, Brett, and Jamal. Thank you all for joining. We are doing a 2-hour school session here in about 13 minutes. It was supposed to be the three amigos, but unfortunately, Dion had an emergency come up, and Matt's got a honey-do list. So we're looking to do the three amigos next Sunday, same time, same place, same 2 hours. But given I've committed 2 hours, I will go live for 2 hours with you. Both Matt and Dion apologize. They sent me several texts trying to reschedule, but we will do it next Sunday. Also gives you more time to think of questions and the like, so look forward to that. On Monday this week, we'll talk about the economic news, and we'll wrap this up. We have 3 Fed speeches. Again, lots of Fed speeches this week, including Jerome Powell on Monday. We will get ISM manufacturing. Tuesday, we get the first of 3 jobs numbers. We get what's called the JOLTS report. Last month, we had 7.2 million job openings. That number has down significantly. It did peak at over 10 million. We will have 3 Fed speeches on Tuesday. Wednesday, we'll get the ADP report, ISM services, and the Fed Beige Book. I'm looking forward to the Fed Beige Book. It's kind of a summary of the Fed districts, what's going on in each. Thursday, we will get weekly and continuing claims. Remember that from last week is a yellow flag. We want to watch that, see if it continues higher. We will get 2 Fed speeches. Then on Friday, we will get the big number of the week, how many jobs were created in May. It is estimated that we created 125,000 jobs in May. Last month, before that, April was 177. And the unemployment rate is expected to be flat at 4.2. Other things I read, it looks like company HIMSS is cutting 4% of the workforce. And according to, I think this was Zillow, home prices are cooling in 99 out of 100 markets. What does that mean? Does not mean prices are down. It just means they're not up as much. Again, this is a sign of what's to come. We actually had a video with Lance Lambert where we were talking about the second half of 25. Seasonality, folks, is going to kick in. It is going to be soft. It'll be very interesting to see where we go from here. Let me make sure I got all of this, as I was a little flustered by the technology issues earlier. Yep, I think I got it all. Folks, I will see you in school in about 14 or 11, I guess 11 minutes. Dion and Matt might jump in for the first 5 to 10 minutes to apologize. They might not. They're both actually driving, so I don't know if they're going to jump in from their phone. But I will see you there, and they will be in school next Sunday, 8 to 10 a.m. Thanks. Bye.